So the cameras are on, the lights are on, and the audio is on. This is the start of our morning trading update, or whatever we're gonna choose to call this. We've been doing this now for this is the second day, starting in the morning, and then we're gonna be moving a little bit earlier in the AM. It's gonna be about a couple of hours, so it's gonna ramp up a little bit today. So the first is the show that we have yet to name, which I call Fill or Kill, and Ed
Let's call it Fill or Kill. Sorry, I tell you why. Because the reason I balk a little bit at Fill or Kill, it's open outcry term, but it's also we haven't got traders.
Well, it's not just open outcry. It's also I mean, there's a lot of trading on the phone still. So Fill or Kill is you do use Fill or Kill in chat as well. So I don't know. It's a cool term.
Yeah. Well, I don't think I've ever used it. Sorry, but anyway, let's use it because it doesn't just apply to trades. I mean, this is one way we want to take this show, call it a show, but in terms of trading, being more hands-on, because that's what it's about.
Yeah.
Also, some of the what we're doing at the moment, we're talking a bit more about some of the concepts that lead to some of the thoughts behind trades. And concepts can be right or wrong. They can be applied and not applied. So with ideas, we can fill or kill the idea as well, which is why, it's not actually kind of nice to, if you want to go black and white, Rabini's perfect storm, Taleb's this concept of volatility. Is it a fill or kill? Is it a good idea? Is it bad? Volatility, no-brainer? It's obvious. We all want volatility as traders, but do we? Does the world need volatility?
Yeah.
Is it necessary? All those questions that you can apply yes or no, or fill or kill. It's not.
And you mentioned Taleb before, and Business Insider's got a nice video up, so we're gonna pirate it a little bit, and hopefully Joe will be okay with it, and Henry as well. So we're gonna just air a little video here that's about 5 minutes long, and it's Taleb talking about volatility and trading. So 1 second, I'm gonna start it.
He's an interesting guy. He's slightly in between the academic and the trader, more closer to the trader than many academics, but he's worth listening to. I can't hear him.
It's fragile. Now, why is it fragile? It took me 21 years to figure it out. It's fragile because it doesn't like volatility. If there's an earthquake in Munich, I'm not predicting, okay, a coffee cup has no upside from it, no? So I was a trader specializing in volatility and how things respond to volatility. It took me 21 years to realize it could be generalized to other things, and started with a coffee cup. A coffee cup doesn't like volatility, and if we take the idea to its natural conclusion, it is fragile because it doesn't like volatility. Okay, let's continue now. Odds are you won't see the connection with the next slide, but in your opinion, which of the two pictures is more attractive, aesthetically attractive to you? The one on the left, the one on the right? Sorry? The one on the right, unless you have some metaphysical angst or you've been doing a lot of substances. Okay, so why is it, and we're going to see what's the connection with the coffee cup, but why is it that the one on the right, the natural thing, is more attractive than the other one? Has anyone ever seen an ugly natural scene? No, okay. Visibly, it's not unlimited, but we like some class of disorder. Okay? One observation, we live today in a very smooth environment. This is from the Vatican Museum. You can hardly find any surface from a classical age that's smooth. Everything has to have some kind of ornament. Why? We don't like smooth surfaces. We like a little bit of dimensionality, a little bit of disorder in what we observe. I'll connect it to the coffee cup, to things that like disorder. But there you go. Now, This is the only slide with words, what I call the disorder brother. Object that like one of them, like all of them. Time and disorder are the same thing, you see, for a physicist. Chaos, unpredictability, and we're going to try to link them, and there's a way to detect sensitivity to disorder by objects. For that, well, I started with a coffee cup. The coffee cup is fragile for reasons that are obvious. The opposite would be something that would not be robust, would be something that thrives, likes disorder, and you had to create a category of objects that are easy to define mathematically, but although a little bit harder verbally, things that like disorder. The opposite of fragile is not robust. It's something that wants mishandling. Okay? Well, it turns out a lot of things like disorder around us, but we sort of don't like them simply because it's the same thing as with sugar. You see, whenever I see a cake, and it's very tempting to be here, particularly for someone who doesn't eat sugar or claims not to eat sugar. I've probably had my 5,000 calories this morning, all right? You can't see any sweet thing without, you know, you can't resist it because we're programmed, you know, for an environment that did not have a lot of sugar. It's the same thing with disorder. Because risk, you know, can kill you, we developed a dislike of variability. But we lived in an environment we could control. So we had thermal variability, we had a lot of variability we can control. Today we can control variability, hence we are harming ourselves, eliminating some classes of disorder. And effectively, we don't talk about these things. How many of you have heard of something called post-traumatic stress, post-traumatic disorder? All right, all of you. How about the vastly more frequent post-traumatic growth? Okay, not that many. Why? What's the reason? What do you think is the reason? Because nobody can make any money try to cure you of post-traumatic growth. Okay? So we have a lot of classes of objects that actually need, you know, when you go to the gym, why? You overcompensate, your body overcompensates. You need some kind of random events, okay? Because that's how you communicate with nature, and you overcompensate. And that's how you grow. So if you make the environment very comfortable, you harm yourself, just like you harm yourself aesthetically by having smooth surfaces.
So, Ed, we've been getting some feedback on the audio. One second, I'm gonna try to fix it. We've been having some audio issues. So it's, thanks for the feedback, and I'm gonna try to fix it. So if you can please keep giving feedback if the audio is now better. So please just send us messages, and but do you care to comment on Taleb's point here?
Yeah, it's not giving feedback itself. He's not made it as clear as he possibly could. What he's basically saying is that markets need to move in order for the world to be stable, because markets are a reflection of supply and demand, but they're also a reflection of various influences, factors that need to be in balance for the world to be in equilibrium, to be in a happy state. Now, the world is, without getting too deep, I think markets are just a series of shifting equilibriums. If you get something that isn't in equilibrium, you start to get problems, and that's why markets move, to ensure that everything is smooth and there's interrelationships that reflect changes in the real world. The problem is when markets don't move, is that, and real things move, you start to get massive imbalances. It's a bit like building a bigger and bigger roof on top of a building built out of hay, and eventually it can't take it anymore and it collapses. So if the markets are not reflecting changes in the real world adequately, then you get these black swans, as he calls them, these outliers. So something like a coffee cup isn't designed, it's stable, it's fragile, isn't designed to be moved about too much. Whereas certain other things, like in the real world, you see nature is far more rugged, it's not so smooth, it's more robust because it can take the shakes. And I think he didn't finish the video, but the point he's getting to is that we need volatility. We need the world to be rugged and rough. We need things like, almost things like the Turkish lira today, blowing out the top, coming back, in order to release the pressures that are there. If it doesn't, if it sat still, if the exchange rate didn't move, then the only thing that's going to move ultimately, well, apart from interest rates, will be the Turkish economy. And if the Turkish economy goes, that reflects the movement that should happen in the currency market, then goodbye Turkish economy. And that's the whole point about markets. When you see people, politicians, I'm going off on a rant now, starting talking about let's regulate things and make sure markets don't move, there actually is a recipe for disaster. Because markets are there, supply and demand, price movement is there, is actually to make the world a more stable and smoother place, ironically. So there's a massive irony. So he's spot on. I like a lot of the things he says. He believes in chaos theory. Slowly but surely over the years, I've come to the same conclusions. But I think his bottom line is yeah, traders, volatility is good, but real people out there with real jobs in a real economy, we need the volatility that people complain about. The question obviously is to what extent, and that's a good place to end, because that begs the question. You get the 2008 credit crunch and all sorts of things happen in the real world because the markets probably, arguably, strangely, weren't volatile enough. But I wouldn't go that far. But it's a good point. It's an interesting point, and it's a point well made.
Yeah. So, what do you think about in terms of the Turkish lira now? Is it so volatile that it's killing potential for return?
Well, the market. What is really interesting, I mean, again, picking up on some of these chaos people, Benoit Mandelbrot being one, it showed that they went through years of, more than years, decades of data to show that when you get this volatility, the volatility in the market is not based on the Gaussian bell curve, the standard bell curve, our expectation of volatility. It's actually much wilder. We get these 1 in 1,000 year type of events happening, 1 in 100 year events happening far more regularly than we should do. And so the problem with, once you get the volatility, actually the next day, let's say you get a volatile move one day, the next day is also volatile, which is kind of counterintuitive. I'm going to take this back to the Turkish lira in a second, because I don't know about you, but most people, I think, accept the fact that markets trend like 20% of the time and they correct 80% of the time. They go quiet before the next trend move, the next move to the next equilibrium point. And when you get really big volatile moves, the next day is a consolidation day. It tends to go quiet as people, they lick their wounds. Some people are out, some people are nervous, but the volatility appears to die. But historic volatility, compared to what it was a week or 2 weeks ago, you look at that Turkish lira chart, and the market's still really volatile today, even though it's going sideways.
And this is intraday here. It's been a rough couple of it's been a rough time for the Turks. This is the yearly chart for the Turkish lira. So it's very volatile intraday now, but it's been fairly consistent.
So it's like a lot of markets we've seen. I've talked about this before on a Wax Lyrical and several places about the succession of bubbles. This is a bubble chart. It looks very similar to a Bitcoin chart. It looks very similar to the Nikkei back in the 80s, 90s. It looks very similar to many other charts we've seen. And what is interesting about it here is we've seen the spike, we've seen the aggressive move, but if you look at before in the rally up in the last year, 2, 3, 4 years, we get these aggressive spikes and then the market dies, it goes sideways. And that's when it provides an opportunity if you believe the trend is still up. And you could classify gold in the same basis. I'm a gold bull, not necessarily at this level. We alluded to that a bit yesterday. But I think gold is dying for like 6 months before it's in a position to go back up again.
Really?
And Turkish, yeah, I definitely do believe that. It's a deflation style market. It's a post-bubble style market where everyone gets involved thinking there's a lot of money to be made here. Whereas in actual fact, there isn't so much, because the market is dying. People are out of the market. They've been burnt. They're no longer in it, and also there's two-way traffic on it, which is interesting, because what typically happens is when you get these sharp moves, some people may not be involved and think this is a market. The Turkish lira is a market to be in. It was like dollar yen yesterday. Dollar yen was the market to be in yesterday because the day before was so volatile. But in fact, yesterday was a two-way move. And what it says to me, this chart on the Turkish lira, is that it's going to go sideways. It's dying for the next maybe as much as a month, 220, 240 trades. Let's go for push down one more time. Let's run up the highs and consolidate, I think, before it goes up again, quite frankly. I'm long of dollar rand, short the rand, so I'm still looking for an opportunity to get out of that. So it's very similar, being an emerging market chart.
But here you have the live chart of the dollar yen. I mean, it's quite. You made the call yesterday saying that this is a nice reversal, and lo and behold, it did.
Yeah, there's a reason. Look, it's very nice. I've got my cap today.
Yeah,
There's a reason I'm wearing this.
I can't really tell what that is.
It's a
Oh,
bull.
match.
It's a
No,
bull.
the bull. Yeah, that's a
Anyway,
pretty ugly cap.
it's not good. It's an old cap. But have you got that chart, or the Reuters volume heat map chart?
Yes,
It's really
I'm bringing it up now.
good chart.
There you go. So this is the heat map from Reuters.
It's based on their real volumes on Reuters matching trading system, and the amounts going through. And red is hot. It's where the volumes are high relative to its monthly average. And you can see that yesterday dollar yen was attracting a lot of the volume because it was the day after the move.
Yeah,
And it's you get volatility when you get from quiet moves. When you get volatility, the next day will be like today. It will be volatile.
yeah,
But it's actually it's pick up on Taleb's point. Is that a lack of volatility is dangerous because it springs into volatility, and then the market is then able to start trending. But the point is something like we've seen the exponential bubble move on the Turkish lira, and I think one more dip, and then it's defined the range for the next month. And then let's look at the next market that's going to do the same thing, because I think it's a succession of bubbles.
yeah.
Markets seem to be repeating themselves in various guises.
So how would you trade this now? Because you mentioned a few instruments, and it's a complicated position to be in, where you have very real potential for a turn, a break in the trend, very long, very 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 long bullish trend, where you have something like 40 months without a reversal. I don't know, something like this, and you never have the correction you need. So the market is so intensely complacent now, and people just,
Which market are we talking about? Stock market?
yeah, I don't know, stocks, bonds,
The risk
all
market.
these like long only style markets where you have this incredible propensity for bullishness, and I'm just wondering, how do you trade this? And I have an anecdote or something similar. I was talking to an asset manager friend of mine the other day, and he made a brilliant analogy, saying something to the vein of, if you're a doctor, if you're not a doctor, you don't show up in an operating room saying, okay, just give me the scalpel, I'm going to take care of this, because this is a profession. And we've seen time and time again people thinking that they can do this better than anyone. So they step in and they got a lot of money, a big fortune, and that big fortune turns into a small fortune. So I think like part of all this investor education should also be that some markets, or maybe most markets, are better left to professionals. What do you think about that kind of a perspective, that you have to
I
take
think he's
education?
nailed it. He's spot on. The markets, stick to what you do well. If you're not doing well, then maybe it's time to rethink about what you do and how you do it. I'm a great believer in trading, as I said, it's my mantra, trading from strength. So try and focus on what you do well and minimize your weaknesses. And if you use a set of tools for certain types of markets, then continue to use them. Certain markets, though, markets change. We're in bubble markets here in the Turkish lira. Other markets are surprisingly quiet. Dollar Canada is a great example of a market that's been quite slow and erratic. Suddenly, is an explosive trend. And your tools that you use, your style of trading in something like a previously in a quiet market should be very different to one in an exponential explosive trend. And that's the difficulty, is that a lot of people test their systems out over 1, 2, even as far as 3 year period, and say, they finally fine-tuned it and got it right, and they think they've got a very profitable trading system. And then suddenly the nature of the market changes. You get these series of bubbles going, you get collapse in the emerging markets, and suddenly it's all very different. There's a great example of a market that's been quite slow and erratic. Suddenly it's an explosive trend. Your tools that you use, you start trading in something like this is a tough one starting out as a new trader, because you work hard and you perfect your system, you think, and then suddenly you enter a new market and your system's not is not equipped to deal with it. And it's not necessarily your system is wrong, it's just you need to be aware that you need to develop and move with the different types of markets. So yes, the doctor, unless you're a doctor, don't. And then suddenly the market on the operating table, if you're the janitor, carry on sweeping around it, or in fact, if you're the rocket scientist, then go and develop rockets instead. But realize that markets change, and therefore your techniques change. Oscillators, stochastics, RSIs are brilliant when it's a ranging market, and the range is fairly well defined. In explosive markets, like we're seeing emerging markets and a few others we've seen, then if the trend is your friend, then you can use a series of different. You use Elliott wave for looking for 5 waves. You can use a rolling stop, moving average, 200-day moving average, tools that are designed for trend. Don't use ranging. Well, it's up to you what you use, but I would never use a ranging technique for a trend. I'm not a great fan of using RSIs in trends, because I've seen so many people buried because they don't recognize the volatility.
Yeah, and that's a good point actually with RSI. Sorry, I had to just turn off my mic a little bit because we had some audio issues. We're still experimenting, so there's some clipping on the audio, so I'm sorry about that. No, but on RSI, it's an interesting point you're bringing out, because so many people think of this as some kind of ultimate guide, and you have RSI is a very compelling prospect for people who don't know much about technical analysis. It's relative strength index, and relative strength index is you're above 70, and then there's it's likely for a turn, and you're below 30, and it's likely for a turn, something to this vein. But the problem with an RSI is it can truly kill you in the markets, where it can a trend can go on for a very long time, even though RSI, every traditional technical analysis should point that it's turning. It's in fact not, because the trend is it could go on for, let's say, 25 years. Who knows? I mean, some trends do carry on for a very long time. So even though the technical indicators are apparently this sort of like truth telling, then it really isn't. I mean, it's trading is such a skill, and it's also a moving target market. So stuff that worked in the 20s, stuff that works in the 70s, stuff that worked in the 90s doesn't necessarily work, even though some truths are eternal truths.
Yeah, I mean that's pretty accurate. And what is interesting since about 2008, you've seen the explosion of high frequency trading that has affected markets. Now people say, well, I remember actually on Stocks and Scotch and Stocks, someone was saying that HFTs don't really affect the markets, but they do. They do significantly affect.
I think that someone was me.
No, that wasn't you actually. They do, because they provide liquidity. That's the whole point. That's why they've been allowed, because you can hit a price and it will be dealt, because you've got all these HFTs providing liquidity to the system. So they're supposed to be stabilizing the system. And obviously the well publicized events are when they don't stabilize, when they all sell and you get flash crashes and stuff like that. But they're supposed to be providing liquidity. Now, in the last 5, 6, 7 years, as a result of the explosion in HFTs, we've had more liquidity, and so it's easier. Technically, you're supposed to be able to stand more chance of being filled at your level as a consequence. Now, if that's changed, there's more liquidity in the market, then the markets have changed. Anyone needs to be talked about DAX being algo driven, robot driven. You only need to look at a DAX chart. I've developed a speciality in it. I would claim. Because it's so robot driven that it's actually
No,
repeats itself on the
it's the
algo.
only
So
real, like, truly digital native market, wouldn't you say?
I don't know the truth behind it. I jokingly had created this monster called Bruno because I found this wonderful picture of Angela Merkel. I'll dig it out and tweet it later. I'm sure people have seen it already. A couple of pictures of Angela Merkel with a robot. One of them says Bruno on his front, so Bruno the robot, the DAX robot. And the other one is when they're both sticking their fingers up at everyone. The wrong finger, obviously, or the right finger. But these things do affect the markets. So do they affect
This is
ultimately?
the image you're referring to, by the way. One second. I guess this is the image you're referring to.
Yes.
Bruno, right?
Yeah. And what? I don't want to go off on one about HFTs and fractals, but what is quite clear, you take someone like Jesse Livermore said back in the 1920s that Wall Street won't change because the nature of the traders and what drives them doesn't change. Sentiment remains the same, and so how they act and so the impact they have on price doesn't change. And yet we talked about how things do change over time, different influences. And yet in the last 5, 6, 7 years, whatever, you've seen HFTs come in the market, and almost ironically, they've actually started repeating price action even more because they're mathematically designed to take the conditions that are prevailing and act accordingly. Well, if they then get another set of conditions which are similar, they're going to do the same thing, and they're going to do the same thing over and over again. And you see it to the markets that they take over, and that's what worries me. Is when they take over to an extent that they take it away from the fundamentals, and that's when you get your fragility, talents. They start creating a type of volatility that is alien to the real fundamentals. And that's when you could argue, not get a flash crash because they all hit the price the wrong way. You get a flash crash because the robots have taken the market too much away from reality. Have you got a chart of dollar yen? I wanted to show
Yes, I can bring it up.
an example, a current example of a market.
This chart?
Yes, this one. Yeah. I don't know if you can see it. If I can see it.
Try and center it. One second. I don't know if this is a good view of it. I'm going to try to bring it up in full screen here. Is that a better one? Yeah, it's not picking up the end of it, but I think it's fine.
Basically, you can see that it's doing the same thing over and over again, but getting larger and larger
Yeah.
each time, which is, arguably it's either going to die and not repeat itself, or it's actually going to get more and more volatile. And the projection there is based on, you could argue that people in the market are doing something similar. The conditions are similar. They're worried about return, and so they're buying and selling and getting stopped out because it keeps breaking down to new lows, rallies, consolidates the top, people gets bearish, and then whack, downs, and they get stopped out again. You could argue that that's what's happening, but it looks robot-driven to me. It's too similar. That the conditions are the same for the trading, the algos, and the algos are driving this market. At the end of the day, one hopes, I think, going back to Taleb's volatility, fragility points, you hope that the fundamentals will drive it. I'm bullish currently, partly on the basis of this fractal, because it says on the basis of that fractal it should go back to 104.10, and then if it carries on the same process, it'll probably break down again. But it's kind of interesting to see how the markets may be changing because of HFTs, but ultimately fundamentals will rule the day, because ultimately that's the money that stays in or out of a market.
If you let's talk about fractals a little bit. I don't want to delve into this and become a masterclass, but you're kind of, I guess, the guy who's become the spokesperson for this phenomenon. And I wonder if you can talk a little bit about why this works, because there's been some discussions on finance Twitter, for lack of a better word, where
Yeah, okay. Let me. I'll take it. Because I don't want. Yeah, I'm known to be a pioneer. I guess as a pioneer of fractals, how they apply to markets. Fractals were discovered, I guess, by Benoit Mandelbrot, 1973. He coined the term, It's basically something that's self-similar, that repeats itself, that shows itself. A rock in a mountain can look like the mountain. A branch in a tree can look like the tree, and that applies to markets. You can pick up any chart and you can find it repeating very similar things, and it begs the question why. I've explained my background. I'm an Oxford economist, and I need to know why. And there are reasons why that happens. I explained, Jesse Livermore's famous quotes about how human traders do the same thing over and over again because they're driven by the same wants, desires, fears, etc., and make the same type of decisions. And HFTs, algos, trading robots, call them what you like, explain, I think, why we've seen a proliferation of fractals in the last few years. But it makes sense. I mean, one of the famous examples I use is the Kobe 1995 Japanese earthquake. This is how I often look for fractals, fundamental fractals, and saying, okay, we've seen a similar situation before, like when we saw the last earthquake. We saw it in 1995. What did dollar yen do then? I go and look at a chart, and then I fall off my chair. I get a tear in the eye because I'm that sad. And I say, it's doing the same thing as it did in 1995. Wow. And then you start tracking it and find out, lo and behold, it did exactly the same thing. And this has been the consequence, exactly the same price action, which is why some people will know that I've used the 1989 analogy with the Nikkei and dollar yen, because the price actions continued for the last 18 months and, caught the bull market on the back of it. So it can be successful. Part of the problem, though, when you get any technique, is when it gets wrongly applied. Now, I'm not going to claim to be get every fractal I ever find right, but I've tried to develop it in a way that's got a pretty good success rate. Sometimes they don't work, but the problem is when people use them to justify their view. In other words, you go looking for something to support your view, rather than you go and find a fractal and lo and behold, yes, it's similar.
So can we talk specifics? Because this is a question I've been dying to ask you for a long time. Specifically, what is the benefit for a trader?
It provides a map. This is the interesting thing. If I told you where say dollar yen was going to close tomorrow, then you say, wow, let's say it's 104.10. Let's say it's that bullish. I don't think it's going to be there, but let's say it is that bullish 104.10, and you go ahead and you buy it, and it drops to 101.50. How are you left? Well, you're out because you couldn't hold it. You were margined. You didn't expect that, and yet then it ramps up and closes at 104.10. The problem is the map. Is taking a map, having a map that tells you where the market's going to go. Having someone that tells you where the market's going and trading are two different things. Analysis and trading are separate things. You have to be cognizant or aware of that. How do you trade fractals? Well, you do it two ways without getting into too much detail. One is you define a fractal. I define the Kobe fractal as in terms of liquidation and repatriation, etc., in terms of the yen. And therefore, that has an bearing on whether it continues or not, because there's a fundamental fractal. Same with price action. I will define the fractals. And then, once I've defined it, does it break the definition? Then it's wrong if it breaks the definition. Or you can use other things without getting too statistical covariance and the amount it varies by and stuff like that. And then it gets very difficult, very hard. But it comes down to the same thing. For me, I don't necessarily trade it tick for tick. I will when I find the tick for tick's the same, but it's a map.
So it's very hard to measure alpha from this. Is that what you're saying? Which is excess return over the market return.
No, it is. No, of course you can measure. No, you can measure it, and it can be that precise. The difficulty is when you're saying how you trade it. You can, let's say the fractals, well, let's say take the dollar yen fractal that says it goes to 105. I gave you an example, it goes to 101.50. It's not in the fractal. That's not in the price action that I see there in front of us. So it shouldn't go to 101.50. So you're long for 104.10 and it goes to 101.50. What do? Well, it doesn't appear to be in a fractal, so you bail out. Well, in actual fact, it might be an aberration or in fact, based on previous times, the standard deviation, whatever, covariance, call it what you like, is not skewed, so you can stay with it. It's tough. And that's why trading and analysis, I come out with a fractal, and I can trade it because I've got enough experience of trading. I trade it as a map. I also then define it and make sure that if I'm going to stay with a position based on a fractal, that I stay within the definition, the criteria. And obviously, I have my own risk return criteria that I stick to in any trade I ever do.
So
But it's,
can I show you something, Ed?
yeah, go on.
Something that I'm kind of springing on you now. This is a kind of a one-man operation that I met at a conference once. It's called Market Memory. So I'm going to show you something on your. It's on your, well, your camera, right? So it's a website, marketmemory.com, and I suggest that people check this out because this is something interesting. I can't vouch for it, but so this site is, now you're seeing my computer screen here, and so what it does is it's using a very similar methodology to fractals, where
Yeah. What is a fractal? A fractal is any piece of price action that can be copied. Yeah.
yeah, and I would say that if I'm gonna say what fractals are, it's technical analysis in the future rather than the past in a way. So you're able to draw stuff into the future, not just based on previous behavior. So I guess the idea of this would be that people generally behave quite similarly to how the world works again and again. So a very good example of this would be today. I'm going to sign up now. I don't know why I haven't signed up. I forgot about this. So let's say today Apple will gap down quite a bit. Apple had had bad guidance, which is terrible for their. It's terrible for the future, and everything is pointing towards Apple having sort of a leveling out effect. And if you look at this from technical analysis, all these perspectives, that's fine. But what if you could automate this to a certain degree? So this is what I really like about. I'm gonna see if I can show you a screenshot of this. So what it does is you choose periods, and you say, okay, in the last let's say in the last 100 days or 1,000 days or 10,000 days. So you want to look for gap moves. So gap up or gap down. I think there's similar. So you would say on gap up, what happens after the gap? A very interesting difference, because different companies tend to behave differently. So instead of supplying you with probability, it gives you 3 charts, and it says these are the different patterns it found in the data. So it's just drawing out a chart into the future, a very specific one, based off of how people tend to react to gap moves. So if you look at Microsoft, for instance, this was right after that big gap move last year in Microsoft that he showed it. And I'm going to install this. Hopefully, I can do it during the show, and I'm going to try to showcase it. But such a beautifully simplistic way of giving you a map for the future. So this is the first time I'm telling Ed about this completely, and I want to know your reaction to this.
I'm going to be rude now. No, no, actually. I tell you why. Because you just expressed what I was saying in a different form. What someone's done there is, I don't know how they it looks like it may be computer driven, but I don't know how they've done it. They basically worked on a premise that markets tend to have a habit of repeating themselves. And they're going in and saying, well, what happens when you get a certain event? In this instance, you say, what happens? What does the market do? What does Apple do? Microsoft do when they gap lower? And you've actually just, what you've done, you then go through, obviously the computer or whatever, the person goes through the charts and etc. and finds out how it trades after the gaps. I've done the same myself with Apple because I've been long of Apple for quite a while, based on actually some other fractals and analogs. It tends to trade very well like that. But what they've done is set the criteria. They set the criteria as this is what does Apple, it defines it. This is what the market does. This is what Microsoft and Apple do when they gap lower. We've got 75% of the time they half fill the gap, and then they continue for the same distance of the gap. So I'm making this up. I've got no idea, but that's what they do 75% of the time. Now, once you've got enough, or you've got a big enough sample, then you can actually work out the likelihood is supposed, in theory, it's supposed to be 75%, or just let's call it a reasonably good probability is going to do exactly the same thing. And that's, lo and behold, it does it 3 out of 4 times, and 3 out of 4 times you trade it on the basis, once you've defined it, you've got your trade sub. Should half fill the gap. I wait for the gap to be half filled. I put my stop above the top of the gap, looking for a movement, which is by definition is going to give me a 4-to-1 risk return on this trade because I'm looking for the same size of the gap again. And there you are. You defined it based on history, based on a fractal. You've got a great risk return probability, and you defined your risk and manage your risk. Obviously, with stocks, you can gap all over the place, and so it's harder to control the risk. But the theory is the same. The approach is exactly the same.
I'm
How
signed
they,
in.
how they
Isn't that shocking how fast I was? I'm already in the system. It's HTML5 and it's here. I just created an account now. So it's now you can. I really want to show this, and this because this is very similar to what Ed has been talking about for years with fractals, but it's just a different take on it. And so this is here is a chart. I think the candlesticks now are daily, and let's do max. So this is Apple's data. So I just signed up for an individual account, so I don't have all the data. So you're kind of walking with me here through this. So I can choose the period I want to analyze from. So I want to start in, let's say, 2000.
Were you using Apple? Go to Apple because there's some
I'm
great
using
stuff
Apple,
on
yeah.
Apple.
So this is me just showcasing how this works. So I want to do analysis period. I'm not really sure. So uh, let's say 10 days after. 10 days after, okay, then we have to find corporate event. So now I'm choosing the kind of event. No, that's not the right one. Let's do, so here you have gap moves. So here, gap up, gap down. And then let's say it's not going to be many gaps. So I'm going to say over 2.5% because I want some data points. And now it's showing me all the gap moves on one chart. And I can give you even, why, there we go. So it's going to be another one today, and this is all gap moves more than but I can tell actually from this chart what you do on these gap moves. But let's do an analysis. So here it's I'm using by the way, this is a free sample. So here is the expected, oh whoops, here is the expected charts in the days following a gap move from Apple. So day 1 is down, of course. Day 2, this is the rank pattern 1. They don't put probability here because they don't want to. So it's pretty much even. You can trade it up a little bit. The second one, big move up. Third one, decent move up. Fourth one, decent move up. So if I'm gonna use this for trading, I'm gonna go ahead and say that you buy on a low, and there's a fairly decent chance that Apple will rise after the gap move based on this. So so historical number of trades in this, it's quite a small sample. So I'd rather use something. So I can show you another one which would have far greater. So on average, you would have a 6.5% return from going long, and win-lose. And if you lose, on average, you lose 3%. So you can gain as much as 16% and lose as much as 10. So here you're given data, you're given hard numbers, and it's an easier thing to deal with. So I'm gonna do another one. So economic event. This is fun. So let's do something that everyone pays attention to and nobody ever. So FOMC forecasts, I guess, meeting announcement, which is today, I think. So this is going to be more. No, that's not. Then it's okay. Gap down and meeting. No. So I took away the gap. So here you have a nice even distribution. This is a typical event. So here you can kind of see. I mean, Apple always goes up anyway. So I'm doing a similar analysis now. 10 days before and after. So Apple tends to move up after FOMC announcements. So you can say FOMC plus plus gap down move means that Apple is probably likely a good buy that you hold for about 5 days, considering these charts. Because here at day 5 you're up 1.5%. Day 5 you're up 2%. Day 5 you're up
Right,
1%.
here's one for you. Does it wait to the more recent type of price action?
Well, you can choose everything. So this is not weighted. It's an
But you
algo.
see,
So
my
here
point
you
is that
see.
market. You can argue that
No, you
because
can
over
set the
time,
range.
the nature of the people, but certainly the robots that may be trading in Apple stock, they change over time, and so the way it trades will change slightly over time as new people come into the market. And so you could argue that you should use, when you've got a series of 5, 10 different similar situations when it gaps down, you should, theoretically, in my opinion, you should give more weight to the more recent examples because that's the price action that was moved and dealt by the current, more likely the current entrance and therefore more likely to repeat it. So I'd be looking,
Yeah, but
I'd
this
be
is
looking
a
at something like September.
$69 a month product here. I mean,
No,
it.
I'm not mocking you. I'm just saying
Yeah, but you can weight it yourself. So this is so if you look at here now on the page, you see all the events and you see the time range. So what you would do is you create 5 time ranges, and you do the long one, the medium one, and the short one, and then you can do your own analysis. So here I did a fairly long one, 2009, 2014, and then you get these alpha curves. Set statistics period. You can do some of you can do. Oh, here you go. Here you have another one. Long bias, short bias. So it
But this
tells
is
you.
this is right up my street, as you can probably tell. It's exactly the type of thing I'd get off, and it saves me a lot of the time. People ask me how I find fractals. I'm giving a few clues as to how to do it because I think conceptually, and then I go looking for the examples, or often don't actually look for them. They find me, but with a tool like that, that's going to help me ask the right questions to get the right answers, hopefully. A lot of people, you talk about fractals, you give it a funny title like that, and then it starts to get misinterpreted, and secondly, people get a little bit frightened or nervous about it because they don't necessarily understand it. We all tend to fear what we don't understand. Whereas in actual fact, a lot of people, more people than you imagine, actually use this approach to not just technical analysis, but to markets. What did it do before? What did the European Union do when it did X, Y, and Z when it had this debt crisis? How did they react? What did the markets do? You ask fundamental questions like that. Every journalist is doing that. Any commentator uses the same approach. So when it comes to technical analysis and what I do, and what I think this product is also doing, is exactly the same approach. The best guide to what happened in the future is what it did in the past. Now, it may not be a perfect guide, but it's better than nothing. And
Yeah.
then once you've got an idea as how many times it did it before and under what circumstances, you can then attach a probability. Once you've attached a probability, you then potentially have a trade, which you can define, which you can put your risk return around. Because it is all about, at the end of the day, trading is all about assessing the probabilities and defining your risk. And Apple, I was just looking at, the point I was going to make is, I just heard what you said, but I'm looking, the 2 big gap trades for me on Apple were last September, a big earnings numbers there, and also this one here was the massive one, the frightening one, was the January last year as well. Both of them traded very similar ways. They did partly half fill the gap, and they did follow through. But if you then pitch your time right to buy it, then you'd be quids in,
Yeah.
because that's basically pretty much what you were saying, and that's what if it does that, then you keep doing it, and there will be times when it doesn't work.
Yeah.
But if you've defined your risk and you've got your probabilities, then you're better off probably than the next guy.
Yeah. No, I just
It's a great
love
product.
these services, and I love highlighting services like this, and I really thought you would get a kick out of this, and I like to do this on air. I mean, I mentioned it to you once or twice, but this is the first time, as far as I know, that you're seeing it. So,
I do see a lot of rubbish,
but
in
this
the
is
name
not
of
it though.
fractals.
And
This
the
is not
guy,
it. This is. I'm gonna sign up and have a
yeah,
play around with
70
it.
bucks. I mean, I'm gonna talk this guy into becoming an advertiser because I want to talk about this all the time. So we sign up. We have a few advertisers now, and we have a few sponsors. So on that note, I really do want to thank our first ever backer. So Ed, I'm gonna just I'm gonna just showcase my terminal of choice in the background here because they're always there, but people might not realize what it is. So what I'm talking about here is the terminal called Infront, and the one I'm using is their new feature is called Pro Plus. So this is the way I watch markets, and as you can see, if I zoom out a little bit from this picture, this is my home screen, and this is live right now. And it's for me the best way to watch markets. So in terms of my setup here, I can bring you up on a full screen so it's a little easier for you to see. This is my setup here. This is how my screen looks. And what you're seeing here is on the left hand side there is a bunch of currencies, and you can see that they're flashing a lot. I don't normally keep this screen open all the time, so I wouldn't be able to stand the flashing. On the it's interesting, on the far right of this there's something called the tweet wires. So I mean, everyone's got currencies, that's great, but this is a feature that I was consulting a little bit with them to help develop. And here is a bunch of specialized effectively Twitter lists, but highly curated, and also some news stories that are changed daily and sometimes hourly. So here, what I keep up is the newswire, which I think is a brilliant way of keeping tabs with the world. So what I'm doing is I'm just keeping up all these guys who share nothing but news, and it's like this Michael McDonough at Bloomberg, who keeps sharing Bloomberg headlines for some reason, and so I keep him up. New York Times Business. There's about 800 sources that are carefully collected together. So this is it's the one of the best ways to follow like basic news. And I just keep it up, and it's like cycling together. It's really nice. And then other screens here is between the next to that is the global benchmark. I just like to keep bond yields up, and I like to keep commodities, so I can just see gold down there and crude at the top. I like keeping futures. Sometimes I have to scroll down to look at Nikkei futures is always an interesting one to watch. The one chart I have is E-minis. Generally, what I do is I'm not trading, but I very much live the life of a trader in many ways, and this is my method of choice to keep tabs on everything, and this is real time. About half of the stuff here is real time, and with the subscription you get a lot of real time stuff, and then if the last one just there is the major equity indices. So ultimately what I get here is a full overview of the world. If I want to catch more stuff, there's something called the Go window, and you have everything on one screen here. It's such a beautiful product. It's cheap. It's I think it's something around 350 euros a month, and you get a lot of live feeds. You get a lot of charting. I mean, I didn't even cover the charts here, and every chart I'm showing on the show is an Infront chart, and you can do so much here. So forget about the more expensive platforms, the more expensive terminals, because this is really all you need. So I want to thank them a lot because, by the way, I'm catching some news here on the right, so that's kind of a sad story. But really want to thank these guys because they've believed in us from day one, and it's not always easy starting something from scratch like this. So I want to thank them for supporting us, and you really should try them out. So if you go to goinfront.com, goinfront, one word.com, you can sign up. And I mean, it's a 7-day free trial. I don't think you even need a credit card. I'm not sure. And most people that try it use it and forget about those other expensive guys. So I'm sorry for interrupting with what it was pretty much the first ad we've ever done here. But the only people we do advertise is people we really like.
Yeah, I wanted to ask you because I quite like those charts you show up. I don't know, maybe it's the color scheme or whatever, but yeah, they kind of for me, charts need to be clean. You see so many charts that have got loads of information, probably all of it really interesting, but there's just so much going on
Yeah,
that you want something a system that's clean and crisp.
yeah, I
Well,
really think that.
I use Reuters a lot. You can probably tell from the
Yeah,
charts.
but you publish on Reuters, don't you?
Yeah.
Don't you have a service there?
Yes. Yeah, I have a also service marketvisiontv.com. People want to tune into that. Currencies, it's going to expand into a few other markets very soon.
Cool.
But yeah, I've been on Reuters for a long time.
Yeah. No,
yeah.
I have to get you on this one because I don't know. Do you pay for Reuters or is that
No,
like what?
I can't say that. No, I didn't say that. But I can't talk about the nature of my agreement with
Oh, I'm
Reuters.
sorry. No, but I'm meaning that these.
Reuters is expensive, so is Bloomberg. You know, I mean,
Well,
compared to,
Reuters is much better than Bloomberg in terms of pricing because you can get fairly low, but you don't get that much, so you can add on stuff. So ultimately, Reuters is a cheaper alternative, and I really do like the direction they're taking their terminals. But still, I mean, in just looking at what you get here and looking at what you get from Bloomberg, it's for me it's an or yeah Bloomberg especially it's an easy choice to go with Infront. I mean I've been using them now for on and off for 4 years and five.
particularly for someone like you, and I would have thought someone starting out, there's one thing to you think you're going to be a trader, you haven't been around that long. There's one thing to build an entire dealing room on the back of how you think you're going to do, whereas you want to keep your overheads down, and that's
Yeah,
one way
but
of doing it.
in this case you're not sacrificing anything. So I mean I don't mean to let this like ad just run on and on, but I'm gonna be mentioning them, and I have mentioned them a long time because they are so good, and you get so much for so little. So you're getting some fractals here on Twitter, I see, and you might. I think we're due for our next show. I mean, this was brilliant. This is our longest talk yet. It's 56 minutes since we started the clock here. So
Well, let me do this and let me finish. We talked a bit about fractals. I showed a dollar, the robot-driven dollar yen. But let me do something, because today has been about a lot about emerging markets, Turkey, hiking rates. It's coming back. I think I think it's going to die down for a while before it's, it could be a reversal. I don't think so. I think volatility is going to collapse, which is kind of where we started the program. But I want to talk about, set it up for a finish about volatility. One of the markets, people know where I'm coming from on the stock markets. They've been tweeting or showing a few of the interesting fractals out there. Have you got a fractal of the this combining dollar yen and the Turkish lira? Have you got that in front of you?
yes, 1 second.
Because this freaked me out. I mean, this is I describe this now as a eureka moment when I find a fractal, something in history that's kind of obvious. People know I've talked about succession of bubbles. Markets the cash in the world seems to be following, going from one market to another. Markets are moving in step within what I think is a series of bubbles. What is really interesting is how some of the emerging markets are going through the same bubble process, but they're not doing it together. I think something like the Russian ruble seems to be lagging the South African rand, and also the Indian rupee seems to be close, in fact, to the Turkish lira. But there's this chart I came across this morning.
I'm not sure I have it here from the rundown. I can cycle through the charts I have here. If so, sorry for people who have to view this. So I have the 2 yen and the dollar and the 2 Turkish lira.
Well, basically, let me I'll tweet it then, and maybe
Yeah, I'm sorry, but it wasn't in the rundown from before. So
You
even
know,
though we
I
planned,
discovered this morning,
apparently,
I just thought it would be a good way to finish, because what it's saying, I mean, the conclusion is pretty powerful as well. And I'll show it, and you make your mind up. Whether you want to get into fractals or not, whether you want to stick to your own tools or not, is beside the point. Just have a look, and you tell me if you think dollar yen is 6 months behind the Turkish lira, because that's what the chart says. That's what the fractal says. Hard to believe, but it's saying something quite significant out there. And and dollar yen is, as I mentioned the other day, the yen is quite key to a lot of other markets, stock markets as well. So it's a very interesting chart. So arguably what the Turkish lira is doing now, and this is very much like the tail wagging the dog, could have interesting clues as to what dollar yen might be doing in 6 months' time, and therefore what the stock markets might be doing. Bizarre, but worth checking out. And the great thing, Surrey, about fractals is that, when it starts to follow the price action, starts to follow history and carries on, then there's a good chance it'll continue to carry on. It will break at some point. But once it does that, you've got a map. You've got a trading map, an idea as to what it's going to do tomorrow, and therefore you've got a better chance, arguably, of making money tomorrow.
I think that's a great way to end it. I'm gonna do a zoom out, and thanks to Ed, thanks to people tuning in, and I'm sorry for the audio issues. We're still working through some of the kinks. So I know we blew out a little bit in the beginning. So I think we fixed it in minute 5. So if you didn't really hear Taleb good enough, it was too loud, you can go to Business Insider and see the video again. So anyway, thanks everyone. Thanks for tuning in. See you tomorrow at the same time. And I'm going to continue on with the news now. So thanks, Ed.
Cheers.